Okay, from here, I'm going to turn things over to our co-chairs for today's forum. Co-chairing today's forum is Deanna Moran, Vice President of Healthy and Resilient Communities with CLF, and Jason Hellendrum, Vice President of Planning and Design for Tetra Tech. Unfortunately, Jason is a little bit under the weather and he can't join us today. So Gabriela Bocio Santos, Associate Director for the Sustainable Solutions Lab, and another member of our organizing committee is going to fill in for him and help moderate some of the panels. So from here, I'll turn things over to Deanna to introduce today's topic.
Thanks, Kelly. Good morning, everyone. Thank you for joining us for today's Climate Adaptation Forum. My name is Deanna Moran. I'm Vice President for Healthy and Resilient Communities at Conservation Law Foundation. As Kelly mentioned, my co-chair for this quarter's forum, Jason Hellendrum, is unfortunately under the weather and can't join us this morning, but I want to give him a shout out for all of his work in helping put today's program together. Today's forum, as you know, is centered on the impacts of climate change on the housing market. We have an excellent lineup of speakers this morning with a broad range of experience and expertise in this topic. As many of you know, homeownership in the US has become increasingly unaffordable. In the past decade, this lack of affordability further expanded, both with shifts in living patterns during COVID and prior to COVID with the 2008 recession. In many ways, the shifts that we saw in the real estate market in 2008 set the stage for where we are today. Prior to the housing bubble burst in 2008, housing construction in the US was in the range of 1.5 to 2.1 million housing units annually. In the decade that followed the 2008 recession, housing dropped to as low as 550,000 to 600,000 homes annually for a number of years. It only recovered recently in 2019 at a rate of 1.2 million. During the same time, the US population grew 6.1% annually. There simply hasn't been enough housing production in the US for the growing population. Looking ahead, climate change is only expected to exacerbate this problem. In recent years, the real estate marketplace Zillow, which maintains residential property listings, has published research on the level of risk in the US housing market. They estimate that nearly 2 million homes could be underwater by 2100 with rising seas. This represents just under 2% of the national housing stock at a worth cumulative $882 billion. Over the past few decades, we've all witnessed the major destruction of hurricanes and other extreme weather events in the US. As we speak, Florida is evaluating the extensive damage done in the southern part of the state by Hurricane Ian. Hurricane Sandy, a decade before, destroyed over 600,000 homes in New York and New Jersey. And those are just two of the many extreme weather events that we've experienced over the past few decades. With increasing heat, we're seeing similar challenges. The Camp Fire in California destroyed 11,000 homes, and temperatures are expected to increase in many parts of the South, making it uninhabitable for large portions of the year. Just this past summer, Dallas-Fort Worth, Texas, recorded 47 days over 100 degrees by August 31st. But the present destruction of housing is not the only concern for housing market dynamics. As climate projection data has become increasingly available and accurate, we're able to predict with much greater certainty which areas of the country will be at risk of climate-related property damage, even if they have never been at risk before. Redfin, a residential real estate brokerage firm, began incorporating data from First Street Foundation in 2021 on future climate-related flood risk, something called a flood factor score, into their property listings. They also recently published data from a home buyer survey they conducted that found that nearly half of respondents who plan to move in the next year said extreme temperatures and or the increasing frequency of natural disasters played a role in their decision to relocate. Another Redfin survey found that 1 in 5 Americans believes that the increasing frequency or intensity of natural disasters, extreme temperatures, and rising seas are hurting home values in their area. And it's not just flooding that people are worried about. According to a Redfin study, homes in high wildfire risk zip codes throughout California, Oregon, and Washington sold for an average of 3.9% less than those in low risk zip codes in 2020. In contrast, the median sale price of homes in areas with low wildfire risk increased 101% since 2012, compared to 88% increase for homes in high wildfire risk zip codes. This disparity only intensifies the affordability crisis in low wildfire risk areas, resulting in home buyers with smaller budgets buying affordable homes in fire-prone regions. So what does all of this mean? In the future, we can expect to see higher insurance premiums, increased home damage, decreased value of homes in at-risk areas, and increased values of homes in low-risk areas, higher property taxes and housing costs. But with these challenges also come opportunities. We've explored some of these opportunities in past climate adaptation forums, including our forum on managed retreat a few years ago, where we discussed climate migration and how populations are relocating from vulnerable locations. These risks raise the question not just where people will live, but what they will live in. Over the past 25 years, the green building industry has grown considerably as the building industry shifts to more sustainable, low-impact development to mitigate the built environment's impact on the planet. The last thing I'll leave you with before I turn it over to our first speaker is that while a lot of the facts and data I recited to you this morning are focused on property damage and property value, the impacts of climate change on the housing market ultimately fall on real people. Lack of housing supply, lack of affordability, destruction of housing will disproportionately affect low income and communities of color. Whether they're forced to relocate from high-risk areas or displaced as people with resources move away from high-risk areas and into lower-risk areas, driving up the cost of housing. We have to consider the unintended consequences of our investments and our policy decisions to ensure that those impacted most by climate change have a voice and power in decision-making processes. With that, it's my pleasure to introduce our keynote speaker this morning, Daniel Coates. Daniel is Deputy Director of the Division of Research and Statistics at the Federal Housing Finance Agency, where he's responsible for using economics, research, and data analytics to enhance FHFA's regulatory policy, supervision, and oversight. He's also the executive sponsor of FHFA's Climate Change and ESG Working Group and chair of the FHFA Climate Change and ESG Steering Committee. Daniel earned his PhD in economics from Columbia University and a master's and bachelor of science in economics from the University of Delaware. Daniel, take it away.
Good morning. Thank you, Deanna. I really appreciated your remarks, and it is a great pleasure to be here. Thank you for the invitation. Just want to issue my standard disclaimer. The remarks I'm about to make today are those of my own and don't represent the agency. While it is true I'm leading up these efforts in climate change, we make decisions at the agency by going through a process, and the director makes the final decisions. So just want to be clear that I'm not making any policy declarations today. I'm just kind of talking to you about a little bit about what we do here and how we're thinking about climate. So with that disclaimer and that thank you, and really appreciated your remarks at the beginning. You hit on a number of really key important topics. If we could move to the next slide. I just wanted to have kind of a scene setting slide. This is the counts, not the costs, but the actual counts of the number of billion-dollar events classified by NOAA. And you can see them broken down there by type of event. But the general trend that I wanted to show is that it's rising. It's something that I think we all know, and it's no surprise, but there may be folks who don't think climate change is a thing, and I think it actually is. So if we could move to the next slide. Climate change can affect borrowers, homeowners, and renters by jeopardizing their homes, the value of the homes, the physical and health and safety of the individuals living in their homes, their financial condition. And climate change can and probably will affect the housing finance market through several avenues, and I've listed them there. Physical damage, insurance costs, technological transitions. We have to worry about transition effects of climate change. So we often think, especially with Ian wreaking so much havoc, about the physical damage, which is tragic. But we also have to think about the transition costs. The change in prices may come, and other effects that could raise the cost of living for folks. Think about it this way: if you're living in a home that's heated by oil or natural gas, and some carbon tax were to come into play, and the price of that of heating that home were to rise dramatically, that's a sustainability issue for the people living in those homes. We also have to worry about, as Deanna mentioned, the changing perceptions of what homes are worth through changes in consumer and investor sentiment. And then the things that we spend a lot of time thinking about at FHFA, the financial risks to our institutions through things like credit risk. We could have more defaults as climate change wreaks its havoc. More market risk. This is something we worry about a great deal. If the market suddenly decides that homes are not worth as much as they're currently valued at, you could have this massive Minsky moment, as people call it. Liquidity risk. Just think about what's going to be happening in Florida as people try to recover. People making withdrawals to deal with the recovery, and then just the sheer business continuity risk of that storms cause. So if we can move to the next slide, I thought I would have a couple of slides about our role. But first, let's talk about what our regulated entities do. Excuse me. We regulate Fannie Mae and Freddie Mac and the federal home loan banks. Fannie Mae and Freddie Mac are firms that buy mortgages from lenders, and they package them into mortgage-backed securities and sell them off to investors and other participants in the market. The home loan banks have been around since 1932. They were actually created by the Hoover administration, of all things. You never would have thought of that, but they did. And what they do is take mortgages as collateral from their financial institution members and then make loans to them. They're called advances. And so there's the transmission channel for our regulated entities. These mortgages have the full risk of climate embedded in them, and affecting borrowers' ability to repay, affecting the value of the homes. And so that's kind of what I wanted to talk about in this slide. Just they also have each of the regulated entities do have programs aimed at promoting affordable and energy efficient housing. And those programs have the potential to integrate more climate solutions that we hope will incentivize more resilient and energy efficient homes. So there's a mechanism that we think we can tap into there. If we move to the next slide, more with, what do we do? Well, our first and foremost, we have two missions. One is to make sure Fannie Mae, Freddie Mac, and the federal home loan banks remain safe and sound, so they can serve as reliable sources of liquidity and funding for the housing finance market. We also have another mission, which is to ensure that our entities promote equitable access to affordable and sustainable housing. So that's been and Director Thompson, Sandra Thompson, our director, has been very, very clear and very strong on her emphasis that fostering objective number 2, as you see on the slide, increasing equitable access to affordable and sustainable housing, will not come at the expense of safety and soundness. So that's, oftentimes folks like to be overly simplistic and say that, well, if FHFA is leaning towards opening up the credit box, if you will, to allow more to get into homes, that they're lessening on their safety and soundness mission. I couldn't disagree with that more. That may have happened in the past, but it's certainly not happening now. This director, Thompson, is very, very clear, and we have a very strong safety and soundness examination divisions that spend every day worrying about what could threaten these institutions and making sure that they're as strong as they can be. Okay, so going forward, some of the things we're trying to do is to make sure that we integrate climate risk into our regulatory oversight, and that our regulated entities understand and manage their climate risk exposures. So not only the physical risk from disasters hitting, but also, as I mentioned, the transition risk, the changes in policies that could come, the changes in insurance markets that could come, the longer term effects of climate change. And we also want to make sure that our regulated entities foster equal access to not only affordable homes, but also climate resilient homes. So if we go to the next slide, I wanted to talk a little bit about what we've done so far. For years, we've had a disaster response team that is coordinated with our regulated entities, other government agencies like FEMA, and external stakeholders to provide temporary relief to homeowners and renters in the immediate aftermath of a natural disaster. So those folks are very busy right now responding to the disasters in Puerto Rico, and just most recently in Florida, and now coming up to the Carolinas. So those folks have been doing this for quite some time, and we've learned a lot from that experience. But last year, we wanted to get, in addition to having that on-the-spot assistance, we wanted to learn more about climate change. So we issued a request for input, or an RFI, on climate and natural disaster risk management. We also held a listening session, and the listening session was taped, and you can watch it on our website. You can also see all of the comments that were submitted, and you can see a summary, of the comments that we wrote to try to characterize the main themes. And I've listed a few of them here. Establishing, the input emphasized the things as you can see on the screen, but I'll just read them briefly, that we should establish a climate risk committee and structure and consult with other regulators, that we should identify and measure climate risk and deal with data gaps that we might have, that we should work on integrating climate change into our supervisory approach, that we should focus on ways to address the built environment, meaning the homes that are already constructed, and try to help them become more green, more climate resilient, more energy efficient. They also talked about the importance of our entities and us disclosing what we're going to do. And a huge number of the commenters really stressed their concern for equity and fairness. And they highlighted the concerns that there could and often are disproportionately strong effects on minority and low-income communities who have been often invested their wealth in their homes. They happen to be in climate vulnerable areas, really through a history of redlining in this country that goes back a century. So this is no fault of their own. So we really want to think on that and try to come up with good solutions. If we move to the next slide, this is kind of one of the things we did. We, in 2021, after the listening session, we met with a lot of the folks who had spoken to us and many others. We talked with other regulators. And so we set up this kind of structure in FHFA to deal with climate change and its effects. So at the top, there's a climate change and ESG steering committee. And that contains all of the kind of senior deputy directors, the deputy directors who report to our agency's director and the office heads. And they're kind of the governing body for this. I'm the chair of that steering committee. And then we set up a number of different working groups, as you can see below. So we have a data and research working group. These folks are trying to figure out what data we don't have and what's the best way to fill in those data gaps. And also they're starting their work to conduct research on the effects of climate change on the value of homes and in a number of different, on borrower behavior and paying particular emphasis to the effects on vulnerable communities. We also have what's called an assessing exposure working group. And really that's to do a couple of things, right? To understand the scenarios that are being posited by many in the world. Those scenarios often talk about, increases in temperature over a 10, 20, 30-year period. Question, how do you translate increases in temperature into human beings' behavioral response, right? What does that mean for insurance companies? What does that mean for the frequency of natural disasters? What does that mean for borrowers' ability to stay in their homes? So that's kind of one of the things that assessing exposure working group is doing. Another thing they're doing, though, is trying to think about, gosh, what happens if we were to have, 3 Hurricane Harveys and a Sandy and an Ian inside of 6 months, right? Could our regulated entities handle that kind of sequence of events? How would they deal with that? So that's we call those kind of stress tests, not in the typical Dodd-Frank stress test, but in a very focused climate basis. We also have a governance working group. We have 2022 has been a real foundational year, and we have worked with our regulated entities, and Fannie and Freddie now have dedicated parts of their board and senior management that deal with climate change. And so that's been a real, you can read about these in their financial disclosures, but that's been a real hallmark of trying to get things moving this year. We have a consumer protection working group. This is trying to, deliver on what I was talking about earlier about how we care about vulnerable communities. So this working group is charged with coming up with some kind of framework that we at FHFA and our regulated entities can use to make sure that when policies are being promulgated or discussed, that the decision makers have a view to what this will how this will likely affect vulnerable communities, those most at risk from climate change. So that's an ongoing effort. We have a reporting and disclosure working group. The SEC has proposed a rule on climate change disclosures. It's not clear when that rule will go final, but we've been pushing Fannie and Freddie in particular, and the banks eventually, to disclose more about what they're doing in climate change. And so the entities each issued what are called SASB reports last year. That's the Sustainable Accounting Standards Board, which has now been kind of moved into the International Sustainability Standards Board. But in any event, it's a set of disclosures talking about not just environmental effects, but also social and governance effects. So they've issued a couple of those voluntary reports, and we've been working very, very closely with them to make sure that those disclosures are meaningful and that we push them to disclose as much as we can. We will continue working in that area. One of the things that the SEC rule will require is emissions, disclosure of emissions, and that's a huge effort. And we are actually working with our regulated entities to make sure that they do the kind of work to get them that they need to do to get themselves in a position to credibly report on their emissions, and not only their emissions, but those of their counterparties, as is required by the proposed SEC rule. We have a group working on green bonds. Fannie and Freddie each have green bond programs whereby they effectively, if a lender is making a loan to a homeowner and that homeowner is making improvements that will enhance the energy efficiency of that home, the lender effectively is able to, by way of the Fannie and Freddie programs, get that borrower a slightly lower rate. So it's kind of a subsidy for that type of energy efficiency enhancements. And we're working to make sure those programs, which have, Fannie Mae, I think, is the leader in the green bond space, but we're not settling for that. We want to make sure these programs are as strong as they can be. And also to the extent that we can learn more about resiliency enhancements that work, incorporate those. There are also programs to support resiliency enhancements, but they're smaller, and I'd like to get those to be more part of the green bonds framework. So much more work needs to be done in that space, even though I think Fannie and Freddie have been leaders in this space. One of the things the director asked me when we were setting this up last year was to make sure that we lived by our own guidance. So she wanted us to set up an agency operations working group, and we have done that. So what does that mean? That means we're trying to lower FHFA's own footprint. So we're looking for ways we can do that. We're working with other parts of the government to understand how they're working to lower their carbon footprint. But I thought that was a really important signal on the part of Director Thompson to make sure we live by our own guidance. Lastly, we have a legal working group. That's just to help all of these other working groups understand what the statutes allow for us to have the enterprises and the banks do, and basically deal with legal issues. So if we can move to the next slide, this talks a little bit about some of the milestones that we have done in the past year. As it says on the slide, much of our work is non-public, so I can only list a few things here. But just one thing that I didn't manage to put on the slide: in December of 2021, Director Thompson issued a statement indicating that climate change was a priority for FHFA and would be a priority for all of its regulated entities. So that's a fairly strong statement indicating, to our regulated entities and to the housing finance community in general, time to get moving on this. We're serious about dealing with climate change. So the first thing you see there is we incorporated climate change in the 2022 scorecard. What is that, you say? Wouldn't blame you. We have a public scorecard for the enterprises that talks about, in broad terms, what they should be working on for the year ahead. But we also have an internal scorecard, and the internal scorecard lists more, kind of quarter by quarter, more specific things that we want them to work on and report back to us. So that's how we do this work with these enterprises in conservatorship. We give them marching orders, and so we put climate change into the scorecard early in the year, late last year. We also developed a climate research agenda that our economists are hard at work on. We also put together a climate change website for the agency's website, which you'll see in a moment. In May, last year we worked with the climate-related financial risk committee of the Financial Stability Oversight Council. Say that a few times fast. The FSOC has a climate committee, and we have been working very closely with them for the last year. We helped write their climate report that was released last October or November, I think it was. And we have now assigned staff to the subcommittees, if you will, of the CFRC, and we regularly work with those folks at FSOC. In the internal front, we're trying to bring our whole agency along to learn about climate. So one of the things we did in May was to have a lunch and learn on the proposed SEC climate disclosure rule, right? We have to have a generalized increase in awareness throughout the agency about what's going on in climate, because it's going to affect all of us. On May 11th, we joined the network of central banks and supervisors for greening the financial system. It's called NGFS. We and many other federal regulators are members of NGFS, and they have specific work streams devoted to things like scenario analyses, things like integrating climate into supervisory processes, and even in education. So we have really enjoyed working with those folks and learning from them and contributing our thoughts to how things could move further along. So that's kind of what we've been doing there. If we go to the next slide, here's the agency's website. You can click on it. There's a link there, and it just talks about what we're doing. As always, there's a constant need to update this thing, and I always worry that we're not doing enough to keep it current. But if we go to the next slide, there it just talks about our membership in the CFRC and the network of the NGFS. The CFRC, I would say, I can't talk too much about that, but that's really, really one of the big focuses there, foci, is to look at data gaps that we all face and how to overcome them, and to form some kind of central data repository for all the regulators to use, and also to think about how to do scenario analyses and other topics. And I already talked about NGFS. So if we move on, I'll kind of wrap up with a couple of thoughts that I thought I tried to make this a little bit about what we're doing and a little bit about things we all need to think about. And that is, I approach this work with a fair degree of humility. We don't know, we're all learning in this space. I am no climate change expert by any measure. I'm not a climate scientist, I'm an economist. So I think we need to understand that we don't know the full effects, but that's no excuse not to prepare. One of the things about this space that's so very, very important is to realize that historical data, something that economists usually really like, may not be enough here, right? If we're looking at climate change, if we're looking at to use a technical term, there could be nonlinear aspects to this thing. There could be kink points, there could be tipping points, and so looking back and saying, well, a financial institution looking back and saying, well, we haven't had that many losses yet. That's not a good enough answer. Maybe you haven't had any losses because your properties are insured in a flooding context because they've been insured through FEMA's insurance program, which is binding for properties in the special flood hazard area. But there are a lot of properties outside of special flood hazard areas. So special flood hazard areas, by the way, is just a designation that FEMA uses. It's a 1 in 100 year frequency of encountering a flood. Couple things about that. One, those maps are often outdated. They're often influenced by political factors. And so they are not always accurate. Two, they take a long time to update those things, on the order of 5 years or so. So we're very, very concerned about properties that the enterprises have and the banks have that are outside of the special flood hazard area, but can be negatively affected. Hurricane Sandy and Hurricane Harvey showed this in great measure. And the problem there is that it's very hard to get information on those properties. So in the special flood hazard areas, for example, the enterprises, Fannie and Freddie, have a requirement that every loan that is made in those areas has to have flood insurance for the life of the loan. And they have mechanisms in place to ensure the servicers, who are the touch point with the borrowers, they are checking that those loans continue to have flood insurance throughout the life of the loan. So that's working pretty well. Problem is, when you get outside of the special flood hazard areas, how do you deal with that? And you could just say, well, make sure everybody has flood insurance. Well, not that simple either, because some properties outside of special flood hazard areas are indeed vulnerable. I used to live in Houston, and I saw a map of properties affected by Harvey, many of which were outside of a special flood hazard area, but there's also ones that are not. So that just becomes a difficult problem to solve. And also to get information about. So anyway, so that's just a point to talk about why we should be a little bit humble. I think regulators and firms need to better understand climate-related risks and how those risks will arrive. And what
Dan, just want to let you know we're at time. Want to make sure that we have the chance for you to answer some questions from our audience that have been coming in.
Let me wrap. I've just got a couple more.
Thank you.
And how those risks will affect them. I often talk to our regulated entities and say, well, look, even if FHFA wasn't here, you'd have to deal with these risks. And at the bottom of the slide, I want to talk about the fact that consumers need access to climate risk information. This is something Deanna talked about. It's really important. I think if you get access to good information, you can make more informed decisions. Now, if we move to the next slide, that'll be the last slide. Firms need to manage their climate-related financial risks. It needs to be integrated in all the areas listed below: governance, strategy, risk management, you name it. We also need to have some innovation here. We need to figure out ways to invest in and incentivize climate conscious and climate resilient building and retrofitting, considering the costs and the benefits. A lot of these costs are very high and are most difficult for lower income borrowers to manage. And in all steps, it's important to consider the impacts on these vulnerable communities. And part of how I think we do that is that while some may want us to do something very, very quickly, oftentimes the best way to do things is to do things over time. I think of food labeling as an example. When food labeling first came out, maybe you were buying some tomato sauce and you just bought it. And over time, you see that label and you start looking at it. And over even more time, maybe you start saying, goodness gracious, I didn't realize there was that much sugar in this one or that much sodium. And you start to change your behavior. That, I think, we all need to make progress in climate, but we're trying to do it in a way that doesn't have an immediate and negative effect on the vulnerable communities. Because if we're not careful, if we were to just implement something, tomorrow, we could really, really harm those most at risk. So I think we can do this in a measured way, in a way that is predictable, and we can have hopefully a real strong positive effect. So thank you. Sorry, I went over time.
Great. Thank you so much, Dan. That was a really fascinating presentation. I think a lot of people don't have a great understanding of how some of the federal agencies are thinking about these questions. So thank you so much. We've got a lot of questions. I'll start with, we have a question about whether or not the ESG Climate Change Committee and working groups that you are on, whether those are based in executive order or an act of Congress. Can they easily be disbanded in a future administration, or are they somehow kind of embedded in regulations that would make them more difficult to rescind?
No, there's no regulation for this. There's, we're an independent agency. There is an executive order on climate that, we're trying to adhere to the spirit of it, but we really are an independent agency. So yes, this is a function of our current director, and that's a fair point. So yeah, I understand that.
Great. You mentioned that properties are required to have flood insurance policies and that there's a mechanism for making sure that those policies are maintained through the life of the loan. Obviously, one of the caveats you gave to that was they're only required in the FEMA 100-year, 1% annual chance floodplain, so that doesn't help everyone. But this question is whether or not the agency is thinking about or kind of balancing the reality that for properties who do have flood insurance premiums, it's very likely that those flood insurance premiums are rising, will continue to rise as we kind of better understand the risks. And how is the agency really balancing that out, knowing that it may, price people out of their homes, but that the insurance policies are necessary to protect?
Yeah, that's a really good question. Probably a lot of that is best directed at FEMA because they have the risk rating 2.0 that did result in some fairly substantial increases. We're trying to look at what we can do to help these borrowers who are affected by these higher insurance rates. And it's too early to say. I don't really know what we can do. Sometimes those insurance rates are a signal to borrowers that maybe it's not a sustainable place to live. But there's there are, it's easy to say, well, you should just adhere to the signal and move on. But people are in these homes, they've accumulated wealth in these homes. So I think it's up to all of us really to try to figure out ways for borrowers to deal with these increased insurance rates. Maybe there are solutions that we haven't thought of yet that with a suitable commitment of resiliency improvements could somehow allow those insurance rates to come down. I don't know the answer. I just know the problem, and I'm sorry if I don't have a better answer than that. But that gets into one of the things we have to work on. But I sure do appreciate the question.
Similar to that, and this may be another area where FEMA is the right federal agency, but do you think that there's a role for FHFA to help facilitate managed retreat from high-risk areas, either in kind of the types of loans that they're making or packaging and selling? And, is there some way that the federal government can help facilitate that at the federal level, since we're having such difficulty putting that into practice at the state level?
Yeah, you know, one of the things about this climate change work at the federal level that's been so kind of inspiring, actually, is that there is a wide recognition of the need for a what they call a whole of government approach. So, you know, that involves FEMA, that involves other parts of the federal government, and it probably involves local governments as well. We've seen recently in the last couple of years where states have kind of tried to induce insurers to come in, kind of giving them a pass on certain financial requirements. And then, you know, disasters hit, the insurers start to fail, and then they leave. And then the state has to set up their own insurance program to kind of backstop. So, yeah, that's, you know, the Fannie and Freddie and the home loan banks buy mortgages and get those out into the market so that they can help the mortgage pipeline move. So there's probably by nature a somewhat limited role we can play here, but I'm not ruling it out, and I'm certainly open to ideas. And one of the things I wanted to say at this session is, you know, I meant what I said at the beginning about being humble about this and about not knowing all the answers. So if people have good ideas, gosh, send them. We're all ears, and oftentimes you get great ideas just by asking questions. And so that's kind of, I think managed retreat is probably part of the solution in some of these areas. I just can't yet figure out how would we help? What could we do? And so with apologies for my lack of imagination on that, that's where I'm at. I'm still learning about these things.
Great. And we've got time for just one more question. This question is, you mentioned how green bonds are helping to support sustainability and resiliency enhancements. I think one thing that we're finding is that while we know kind of what needs to be done in terms of retrofitting to properties to make them more energy efficient, there's less kind of guidance out there on standards for resilience. And so the question is, what types of resiliency enhancements are you supporting through green bonds?
Yeah, we have one of the entities has a home remodeling program that looks at resiliency. And I'm sorry, I don't have the specifics of that program, but some of the things that come to mind from what I've read, simple things like making sure the roof of a home is firmly attached to the walls. That sounds pretty crazy, but it's often the case that roofs just fly off. I mean, you've seen the videos of this, you've seen the after effects of this. So something simple like that is a big deal. Using longer construction nails is part of that solution. I read one the other day that apparently in mobile homes and perhaps in others, having the door close or open out is somehow better for resilience than having the door open in. I don't understand the physics of why that happens, but this is an area that we need to do more work in, because it's most of the green bond work that's going on at Fannie and Freddie is mostly energy efficiency stuff. And a lot of it, I should say, I didn't mention this earlier, a lot of it is targeted at low and moderate income communities. So I think that's entirely appropriate. There's a huge overlap here between the Director Thompson's efforts to increase housing availability for those who have previously been cut out of the market, and sustainable housing and climate. And so I think that's part of that's part of the effort here. Some of the resiliency improvements have to happen at the kind of the more aggregate level. Witness the changes that have taken place in New Orleans that have actually made a significant difference. So this is part of the thing. We have to use that whole of government approach, see what communities can do in the way of maybe even seawalls or changing grading, but also what homeowners can do. And we have to be careful because we have to make sure that the resiliency improvements actually do good, right? And there's potential for fraud here. There's potential for solutions that don't actually work. So this is kind of some of the things we're working on.
Excellent. Well, thank you again so much, Dan. Really, really great presentation. We're going to switch gears now. Our next presenter is Lee Reiners. Lee Reiners, Duke Financial Economics Center and a lecturing fellow at Duke Law. He directs Duke's Climate Risk Disclosure Lab, which acts as a hub for sharing information and ideas on climate-related disclosure standards. At Duke, Lee teaches financial regulatory policy, cryptocurrency law and policy, climate change and financial markets, cybersecurity and interdisciplinary law, and he seminars related to financial policy and regulatory practice. His broad research agenda focuses on how new financial technologies fit within existing regulatory frameworks and financial regulatory response to the impacts of climate change. Lee, over to you.
Thank you, Deanna. It's a pleasure to be here, and good morning, everyone. And I'd also like to thank Dan for his excellent remarks. I certainly learned a lot, and I appreciate what he and the team at FHFA are doing on this critical issue. So, Dan actually covered some of the issues that I planned on talking about, so we can, maybe speed through some of those sections. But I also plan on going a little bit into more detail on some of the issues Dan raised, and what could be some potential outputs of the various work streams that Dan walked us through. So, just starting off with a level set here. As Dan mentioned, the Financial Stability Oversight Council, which was created by the Dodd-Frank legislation in the wake of the 2008 financial crisis to be, the U.S.'s systemic risk regulator, really, looking out at the landscape of potential threats to financial stability, identifying them, developing recommendations for addressing them. They came out with a landmark report last October. I think someone put it in the chat, and I highly encourage folks to take a look at that. And they said that climate change does represent a threat to financial stability. And that's a pretty obviously a big deal when you have a regulatory agency like that say that. And so there was a number of recommendations in that report for all federal financial regulatory agencies, not just the FHFA, the Securities and Exchange Commission. Dan mentioned their climate disclosure rule, the banking agencies, the Federal Reserve. So, really kind of the whole of government approach, as Dan said. And so when we say that climate change is a threat to financial stability, what exactly does that mean? And so, we can bucket climate-related financial risk into two categories. First is the physical risk, which refers to the harm to people and property arising from acute climate-related disaster events such as hurricanes, wildfires, floods, heat waves, as well as longer-term chronic phenomena such as higher average temperatures, changes in precipitation patterns, sea level rise, and ocean acidification. Of course, all of that is going to have an impact on economic activity. And then you have transition risk, which refers to stresses to certain institutions or sectors arising from the shifts in policy, consumer and business sentiment, or technologies associated with the changes necessary to limit climate change. And really the risk for this category will be if we have sort of an abrupt policy change. It could result in things like stranded assets, for instance. So the threat to the housing and the mortgage market, as you might imagine, principally comes from physical risk. There are some transition risk concerns, but it's mostly physical risk. And when you consider the fact that housing represents approximately 17% of U.S. GDP, you can understand then that climate, its impact on housing, is going to have substantial impacts potentially on our nation's economy. But there's a lot of uncertainty, right? We don't have uncertainty in terms of the climate and how it'll evolve and change, how that will play out in terms of severity and frequency of severe weather events. And there's also just a lot of data gaps, I think, as Dan mentioned, and we don't have models, frankly, at this point too, to kind of understand how climate events will play out on firm balance sheets and in the financial context. So like Dan, I approach this topic with a degree of humility here. So Dan showed this a kind of a version of this chart which looked at the count of $1 billion extreme weather events in the U.S. going back to the 1980s, and this was from the FSOC report. But this chart also shows the total cost on the right-hand scale in billions of dollars, and you can see that 2016 was the I forget, it might have been Harvey, I think was what's driving that one there. Given what we've seen out of Ian so far, I fully expect that at least from a dollar standpoint, 2022 might be, the most damaging severe weather year that we've had. Now, of course, part of this is attributed to climate change and growing intensity and frequency of severe weather events. But part of it is also due to the actions of the public and private sector. There's a greater exposure to cities and populations and assets that are more exposed. So people are increasingly moving to a lot of these areas as well, and that's going to drive up the dollar impact. So how exactly does climate change impact the housing market? Dan touched on some of this. The Commodity Futures Trading Commission, which is the regulatory agency responsible for overseeing derivatives markets in the U.S., they were actually the first regulatory agency to come out with a report on climate change. I also encourage folks to take a look at that, and it's hyperlinked when you get the slides. You can take a look there. And they came out in September 2020, and they summarized sort of the existing state of literature around climate and the housing market. And what they said was basically that people are increasingly aware of areas that are more prone to climate risk, particularly flooding, and that increasing perceptions of physical risk is already depressing the prices of homes exposed to sea level rise. In addition, perceptions of flooding related climate risk are currently priced into some real estate markets, including high-end markets like Miami. But climate risk, of course, is broader than just flooding. And so, they found that the price of homes drops when they're designated to be in a wildfire risk zone. Deanna mentioned earlier, Redfin, which is an online retail brokerage, and they've been doing some interesting experiments when it comes to their platform and users around climate information. And so they actually conducted a randomized controlled trial that involved 17.5 million users. And what they did is they split up those users into two camps. And so one group got to see flood risk scores, and the control group didn't see any of the flood risk scores. And what they found was that, so users who were looking at homes with an average flood risk score of around 8.5. So, it went from 1 to 10, with 10 being the most at risk. So 8.5, which was in the severe extreme risk category. If you were looking at those homes prior to the study, once you saw the flood risk scores, those users went on to bid on homes with an average score of 3.9. So bid on more moderate risk homes once they got access to this data. So users who viewed homes with a similar flood risk score of 8.5 before the study, but didn't get access to the data and the score, they continued to bid on homes that were in the severe extreme risk category. And so I think this just demonstrates the role of disclosure and how that will influence consumers and buyers' decision making, and ultimately housing prices in a lot of these at-risk communities. Freddie Mac, an economist there, along with his co-authors, found that an increase in vacancy rates, neighborhood blight, and lack of amenities will also exacerbate the decline in property value. So these impacts will feed on each other. Once prices start to go down, that's going to depress just local economic activity. It'll ultimately impact municipal finances, and so the risks are broader. And along with that, the climate, the dangers there, as Dan alluded to, are exponential. I mean, we can't look at the past to understand what the future is going to look like from a climate standpoint and from an economic impact standpoint, because we have feedback loops, we have tipping points, as I'm sure you're all aware. And so that means that longer dated assets are going to be more exposed than shorter term assets. And of course, the 30-year mortgage is one of the most longer dated assets you can find in our financial system. So that is going to impact housing in the mortgage market significantly as well there. So Dan touched on some of this. The expected value of flood-prone properties is going to touch a number of different entities in our economy. Obviously, it's going to impact homeowners, the value of the real estate in these areas, lenders that hold mortgages that are exposed to flood risk. They're going to be impacted. It'll impact the price of mortgage-backed securities. Of course, the profitability of firms that are using these at-risk properties. As I mentioned earlier, municipal finances will take a hit. And then, Fannie Mae and Freddie Mac, as Dan touched on, and I'll get into more detail there. Now, of course, if we had perfect information, you might say, well, the market is already pricing in, this risk. They fully understand, everyone, at this point understands that climate change is real, it's happening. It's only going to get worse from an economic standpoint. And so prices already reflect this information. And there's a couple of retorts to that. One is, as I mentioned earlier, just tremendous amount of uncertainty here in both the climate and in the financial context. But in addition, we just don't have a lot of information around, who is at risk and who is exposed. We are moving in the right direction in that front. A lot of companies are already voluntarily disclosing climate risk information. The SEC in March, as Dan mentioned, came out with a landmark draft rule. It's still a draft at this point. That would require all public companies to disclose specific climate risk information, including their scope 1 and 2 emissions. And if you're a larger company, your scope 3 emissions. And so, once, if that rule is finalized, that will really, help the market understand kind of, which firms and areas are more exposed. And then we can kind of bake that information into prices. But I think it's pretty clear at this point that, the market is not pricing in fully the climate risk here. And so that means that we could have some type of, big sort of repricing shock of severe weather event, or as Dan mentioned, perhaps you have, Katrina, Harvey, and Ian all within a 6-month period. And then that could lead to, the market radically, changing their valuations on certain assets, similar to what you saw in 2008. And that could lead quickly to some type of financial contagion event. So if there were to be major flooding of residential and commercial property over a large region, and maybe, and Ian might be it here, we'll see rising mortgage delinquency and prepayment rates. We're going to see falling values of residential mortgage-backed securities, securitized commercial real estate loans, the bonds of affected municipalities, and of course, insurance companies to the extent that they have to make large payouts there. So what is the role for the government-sponsored enterprises? As Dan mentioned, Fannie and Freddie provide financing to lenders for nearly half of mortgages in the U.S. And it does this by buying them and packaging them into mortgage-backed securities, selling them to investors. Fannie and Freddie then guarantee the default risk on the mortgages they securitize. And this, of course, serves all of us, pretty well, because it makes mortgages cheaper and more available across the country. And it also makes, the U.S., I think, is only one of 2 countries in the world that has a 30-year fixed rate mortgage. None of that would be possible were it not for Fannie Mae and Freddie Mac. Stan also mentioned they have a statutory mandate to promote affordable housing. Dan didn't touch too much on the history, but until 2008, Fannie Mae and Freddie Mac were private entities. There was what was known as an implicit guarantee, which provided a funding advantage to Fannie and Freddie. Most investors assumed that should they get into trouble, that the federal government would come in and backstop them. And, of course, that assumption was right, because the GSEs got into big trouble in 2008. The government injected a lot of capital into them, and then took ownership, placed them into conservatorship with strict oversight, of course, by Dan at the FHFA, and they remain in conservatorship. I should also note that, the previous administration, did try, but, was ultimately unsuccessful in spinning Fannie Mae and Freddie Mac back into private hands. And, they say that, Social Security and Medicare are sort of the third rail of politics. I think we got to add, Fannie and Freddie to that list as well, because this is, of course, a very political issue here. But for the time being, Fannie and Freddie remain in the hands of U.S. taxpayers, and that I think provides an opportunity for the government to really push them. And Dan touched on what they're doing there to think about climate. So I should also know that the GSEs do transfer a significant portion of credit risk to the private market through instruments known as credit risk transfer securities, and these are going to be purchased by large institutional investors, but they still retain a significant amount of credit risk on their balance sheet. So what do the entities themselves say about climate risk? So I looked at both Freddie Mac and Fannie Mae's annual report, and both of the entities acknowledge that climate change does pose a threat to their balance sheet, right? It's a credit risk for sure. But overall, actually, I would characterize them as sort of minimizing the impact of climate. And in fact, Freddie Mac said that historically they haven't had much losses from natural or environmental disasters. As Dan mentioned, they both require all homes to have homeowners insurance coverage in addition for homes that are in FEMA designated flood zones. They also require flood coverage. And Freddie Mac also went on to say that, because of the diversity of our portfolio, right, they're not just guaranteeing loans in Florida or in coastal areas, right, throughout the country, that helps them. In addition, borrowers have, to the extent that they have significant equity in their homes, they're going to want to continue to make their monthly payment. That lowers some of the risk. And in addition, there's, after every natural disaster, there's generally federal and state government relief that lowers the credit risk. So again, sort of downplaying the impact here. And Fannie Mae made similar comments in their annual report. They also noted that, for most borrowers who are in, or homeowners who are in a flood zone, they get their insurance through the National Flood Insurance Program. And this is also a political, hot button issue here. So, if Congress fails to extend or reauthorize the program, FEMA may not have sufficient funds to pay claims if there is flood damage. In addition, borrowers may not be able to renew their flood insurance coverage or obtain new policies. I mean, really, the private insurance market is getting out of the business of providing flood insurance. States are stepping in, providing a number of state-backed flood insurance programs, including in Florida, and I'm sure that's about to be stressed in a big way. So, Dan mentioned that, mortgage servicers, which are the entities that are collecting the principal and interest and sending them on to the ultimate investors, they're responsible for monitoring that the property has flood insurance. But if you had some type of extreme weather event or flood insurance, sort of expired or couldn't be, obtained by the homeowner, that could quickly kind of overwhelm mortgage servicers if enough people, this was happening to. And we saw how mortgage servicers quickly were overwhelmed in the 2008 financial crisis, and that led to things like robo-signing and all sorts of bad practices. In addition, an extreme weather event is going to impact the local economy and will have long-term implications. So if it depresses economic activity in the area, then that's going to impact everyone who lives in that area. Then there'll be job losses, things in that nature. So that'll expose Fannie and Freddie to increased credit risk. As Dan also mentioned, neither Fannie or Freddie require property insurance or flood insurance outside of FEMA flood zones. And Fannie actually provided some statistics here. They said around 3% of their loans in single-family properties were located in flood zones, and 6.3% of loans in their multifamily book of business were in flood zones. So what are the real risk here? Well, as I mentioned, Fannie and Freddie are not currently pricing climate risk, aside from guidelines that prohibit them from securing loans that are located in special flood hazard zones, not with flood insurance. So they're not declining to buy mortgages that are in, flood, in flood zones outside of the FEMA maps. And as Dan mentioned, these maps are not perfect by any means. I mean, there's a lot of data out there that says, there's far more property and territory that's at risk of flooding. They're not updated frequently enough. So there's significant climate risk, on the balance sheet of Fannie Mae and Freddie Mac that isn't going to be insured. In addition, there's information asymmetries here, because banks, especially kind of, community banks, regional banks, have a better understanding of the areas that are more exposed to climate impacts. And that means that they might be selling, sort of the riskiest mortgages to Fannie and Freddie and sort of passing the buck. And, there's some anecdotal evidence that that's happening. Perhaps it's not robust, but nonetheless, again, we saw a similar dynamic play out in leading up to 2008. We also know that the GSEs are significantly undercapitalized. That was kind of the issue with spinning them back into the private sector, is that the FHFA and its previous director was trying to accumulate more capital in the entities so that investors could have some comfort that they were safe and sound when they got spun back out. So if there were to be some type of, again, large extreme, weather event, they could, and there was going to be a lot of defaults, that they could come under stress. And that means that the taxpayers ultimately could be on the hook here for default risk associated with the impacts of physical risk. I think it's pretty clear that if Fannie and Freddie were private entities, they would be pricing this risk, and they have an economic incentive to price climate risk. So I think it's fair to ask, as taxpayers, why should it be any different under conservatorship? And in fact, conservatorship does provide an opportunity, as I said before, to push them here. So what should they do?
I want to let you know that we're at about 10:20, so want to make sure that we have a little bit of time for questions.
Sure, I actually think this is my little last. I have 2 slides left, and they'll go quick. So what should they do? Well, one, invest in high quality asset level data on all sources of climate risk, not just flooding risk. They're starting to do this, as Dan mentioned. This data is out there. It's becoming more available. Hedge funds, sophisticated investors are buying it. Certainly, the government should get access to it. Once they do, they should make it public, and it should be used to update FEMA's flood maps, so they reflect the real probability of future risk, not just historical risk. I think there's, FHFA, along with the GSEs, need to conduct stress tests and scenario analysis around climate risk, and that this should inform the whether or not they're sufficiently capitalized. Actually, just yesterday, the Federal Reserve announced that next year they're going to do a climate scenario analysis involving the 6 largest banks, and so there's no reason that FHFA can't do something similar with Fannie and Freddie. And then Fannie and Freddie do charge, every time a loan is sold to Fannie and Freddie, that lender has to pay what's known as a guarantee fee to Fannie and Freddie, and that's how Fannie and Freddie make money for the most part. And that fee is going to cover a number of elements. It's going to cover the expected cost of default, a fee for the Treasury Department, administrative expenses, and then the cost of holding the capital necessary to protect against catastrophic losses. And it's really that last component where I think there's an opportunity here to price in climate risk into the guarantee fee. So you would charge lenders a higher guarantee fee for selling loans that are more exposed to climate risk. And so that's something that is not easy. I'm not pretending that it is easy. There's significant trade-offs here. Ensuring that mortgages pricing reflects climate risk will help with adaptation and management treat. And it'll do that in part by decreasing the cost of purchasing a mortgage in lower risk areas, but it'll do that by increasing the cost in higher risk areas. And, that means that, prices will go down to the extent that, they're designated to be in areas that are more at risk, and Fannie and Freddie are charging higher guarantee fees. Lenders will pass those costs on. And so there's a potential impact for, homeowner equity to take a hit here. And, this is of course, troubling and concerning, especially when you consider the fact that, homeowners in flood prone areas are disproportionately minorities and low income folks. So, they could potentially bear the brunt of this policy change. But I think it's also worth noting that, if they continue to live in these areas, they're still going to be economically impacted. So there are no, easy solutions here. And that's why I think if Fannie and Freddie, with the FHFA's prodding, were to charge higher guarantee fees for climate risk, that there needs to be, some other kind of supplemental program, passed by Congress that would involve equity redistribution. And this is not, my idea. Actually, Lindsay Owens, in a paper for Roosevelt, said that, one policy could be that, for the government, they could buy homes in these exposed areas at above market rates to compensate homeowners for potential equity losses. But again, these issues are political, and there are trade-offs here. But I think it's time for for FHFA to think about how they can influence, manage retreat, so that the GSEs can continue to fulfill their needed role in our housing market. So I'll stop there, and happy to take any questions.
Wow, thank you, Lee, for an extremely thorough presentation. You answered a lot of the questions that were coming in, especially with that last slide, which was really, really great. Thank you. A couple of questions that I don't think you quite hit on. So one, I know you just talked a little bit about how we can help kind of prevent the worst outcomes for low, moderate income homeowners who might end up getting stuck in high risk areas as their property values decline and kind of have no way out, and a role that the government could play in buying out those properties. A related question is, should Fannie and Freddie Mac actually be considering pulling out of high risk areas in terms of their lending, especially as presumably the private market at some point will also start to pull out of lending in those areas, and what might the unintended consequences of that be?
Well, I'm sure, as Dan would tell you, they have a legal obligation to serve the entire country. So they simply can't say, you know what, we're not going to guarantee any mortgages in this area. So that's just not an option, for them. But they can certainly influence, pricing, and that's the nature of markets. Markets respond to prices, but as I said, they don't have the legal authority to say, no, we're not going to, buy these mortgages in this area.
Related question. It was noted that certain types of government loans, loans for single family homes might come with more stringent requirements for borrowers, like a requirement that an inspection be done before a mortgage can be given, that kind of thing, whereas the private market maybe doesn't have always some of those more stringent requirements. Is there a universe where Freddie and Fannie Mac could actually require some type of resilience audit before approving a borrower for a loan, and would that be a way to manage their risk for properties?
Well, again, that's probably a question that Dan could answer better than I could, but Fannie and Freddie do establish underwriting standards. So they have, clear criteria to say, we will only buy a loan that meets, these factors, right? So obviously, there's a cap on the loan amount, but there's also, loan to value, things of that nature. So I do think that there is an opportunity there in that underwriting process and those standards that they put forward to think about resiliency and climate. And as Dan alluded to, more importantly, disclosure. Should lenders be required to, when they attach that loan file and pass it along to Fannie and Freddie, should they be required to disclose more information around, is this loan in a flood prone area? What's the history here? And I think the answer is yes there. But we have to be, recognize that to the extent that this increases cost on lenders, and that's just the nature of regulation, it's always costly to comply with, that's going to get passed down to borrowers. That's just the reality. And now that the 30-year fixed rate is around 7%, I don't think people would be too thrilled if Fannie and Freddie were to do anything that would drive up that price any further. So again, these are all trade-offs here, and there's just no easy answers.
This next question is a little bit different. It's about what you perceive as being the risk for municipal and state governments, particularly around bond ratings, for having a lot of these high-risk properties within their boundaries. And is there any relationship to what you're seeing on the financing and lending side to kind of what the impacts might be on bond ratings?
Yeah, I mean, I don't So on the rating specifically, I don't think the rating agencies have sort of, downgraded a state because of climate risk at this point. But these are sophisticated investors, certainly in the muni market. I mean, by and large, these are institutional investors playing here. And so they look at the data as well. And the reality is that it's going to, borrowing costs will go up for municipalities and states that are more exposed to climate risk. And that's going to put budgetary pressures, on these states. And so, they have a benefit of being tax exempt. So that gives them a bit of a funding advantage there. But by and large, over time, you're going to see, I think, borrowing costs for these areas go up. And then that's just going to, force them to cut back on services that are needed to mitigate the impacts of climate change as well.
Great. One last question for you. Someone's wondering, what will your center be researching related to this topic? How are you building on the work that you've done so far?
Yeah, I mean, so far we've really been focused on the issue of disclosure. So, we have weighed in heavily on the SEC's climate disclosure rule. We're actually cited a dozen times in that rule. Also doing some work around ESG investing, and that's another area that the SEC has weighed in. So, you've seen a number of funds call themselves, ESG or sustainable to capitalize on growing investor interest. They're not really changing anything about their investing mix. They're hiring charger fees. The SEC is saying you have to disclose, what it means to be sustainable. So we're weighing in on that. And then, really, I think on this issue as well, we're going to continue to think about, what Fannie and Freddie can do, should do, to help, orchestrate a managed retreat, because that's really what we need to start thinking about. We can't continue to rebuild and finance in these areas because the problem is only going to get worse.
Thank you all so much so far for some really fantastic audience engagement. We will get started again here shortly. Perfect. All right, Gabrielle, we'll introduce our next series of speakers.
Thank you very much. So welcome back. We hope you had the chance to take a quick little break, and I'm loving the engagement in the chat, as Jessamine said. So now I would like to introduce our next 3 speakers. Each of them will be presenting, and then following those 3 presentations, we will have a panel discussion. So please continue to submit your questions to the chat, and then we will address them all at the end during the panel discussion. And if you are directing your question at a particular speaker, then you can make note of that in the chat as well. So first off, we're going to be hearing from David Downs, who is a community development practitioner with over 15 years of diverse experience in affordable housing development, program management, and as a planner with established nonprofit, public, and private sector relationships. Currently, he serves as the Vice President of Catholic Charities POP, Progress of Peoples Development Corporation, which is the affordable housing development affiliate of Catholic Charities in Brooklyn and Queens, New York. There, he works to strategize, plan, and implement affordable housing and mixed-use real estate development and sustainability projects as part of Catholic Charities' POP development portfolio. He also advocates for strategic planning efforts focused on affordable housing development, policy, and sustainability models, including energy efficiency, resiliency, and healthy living. We're very excited to have David on with us today. After him, we will have a presentation by Jane Carbone, who is the Director of Housing Development for Homeowners Rehab, Inc., also known as HRI, a nonprofit affordable housing developer in Cambridge, Massachusetts. Jane oversees the development of affordable rental and home ownership opportunities from pre-development all the way through to construction. She initiated the framework for HRI to incorporate sustainability into all of their developments, which is over 1,600 units and over 60,000 square feet of commercial space. She received her BA in Environmental Design and City Planning from the University of Massachusetts at Amherst and is a licensed construction supervisor and lead AP professional. Thank you so much, Jane, for joining us today. And then finally, we're going to hear from Laurie Schumann, who is the Director of Climate and Sustainability for the Enterprise Community Partners Capital Division and sits in the Office of the President, where she directs efforts around ESG strategy, finance, development, and management of climate risks for affordable housing across the nation. Laurie is a deeply committed multi-sector climate risk reduction leader with 20 years of experience working in affordable housing, climate finance, community and economic development, equity and environmental justice, and federal and local policy. She is the co-chair of the New York State Climate Assessment Buildings chapter and also co-facilitates Resilience 21, a network of practitioners across the U.S. advancing climate risk reduction and adaptation. Schumann has an MUP from Hunter College and a BA from Smith College. And with that, I'm going to hand it over to David. Take it away, David.
All right, Gabriella, making sure my audio works before I get started. All right. Morning, everyone. Appreciate the introductions, Gabriella. I know that was quite a lengthy run through, but I think it's a lot of good information that we have here on our side to discuss. And I think that the framework that both Dan and Lee provided this morning, is a really broad platform that I think as a practitioner is introduced to my side, we struggle with on a daily basis. So this is a good refresh just on sort of where we are nationally, the good, the bad, and sort of what the next generation holds for us. So Justin, we can go to the next slide. Great. So as previously introduced, my name is David Downs, and I represent Catholic Charities of Brooklyn and Queens. And I'm really excited to be here virtually on behalf of the Climate Adaptation Forum. First, I'd like to personally thank the Environmental Business Council of New England and the Sustainable Solutions Lab at the University of Massachusetts at Boston, both for the invitation to speak with this audience about our mission to develop quality, resilient, affordable housing in the small boroughs of Brooklyn and Queens. It'd be helpful, if folks are comfortable while I'm talking and as we dive into the Q&A with the panel, just if anyone has affiliations, with a not-for-profit entity, your geography, I see a lot of folks here from Boston, but if anyone's coming from outside the greater New England region, that'd be helpful to know. And if anyone here is, actually working directly in the field to support affordable housing, to support or develop affordable housing in your community. So I think that might help us have a broader Q&A, and we'll look for the questions in the chat as well. Next slide. So for nearly 50 years, my nonprofit organization, Catholic Charities Top Development, has built and managed over 4,400 affordable housing apartments across the boroughs of Brooklyn and Queens. And in light of the long shifting climate changes that we're all starting to experience or have experienced here in New York and in other parts of the East Coast and beyond, we've made a conscious pivot to implement both energy efficiency and resiliency projects, including community solar, through our mission-aligned Laudato Si Corporation. So I'll be using those pieces today to frame where we've gone and what we're headed towards next. Next slide. So I think the big question, I try to take a step back and, as we got into the framework this morning, is how did we get here? I think, again, Dan and Lee, put out a great framework of what the challenges have been from a regulatory and policy side. But just to really think about what's happened in New York and Boston and other coastal cities, I think we've all experienced firsthand or come to understand, quite clearly in the last decade, the impacts of climate change events. Specifically here, I'm showing Hurricane Sandy from October 2012. We're approaching the decade anniversary of that here in New York and as well as other parts of the East Coast. And what an incredible impact it had, not only on the New York and New Jersey region, but also as it pertains to our planning, as city residents, as affordable housing developers, and all the different sectors that we're representing today. Due to time constraints, from this presentation, I can only simply recap that the impact on our affordable housing portfolio from Sandy was shockingly quite limited. We have properties that sort of touch all the different major communities of the boroughs. and only one that was in construction at that time actually had a physical impact. But we really saw at that point as a wake-up call, for our development work, as in New York and beyond. And then I think a follow-up to that was just last year in 2021, in late August, flooding from Hurricane Ida was another very visceral reminder that we have really far to go to address the infrastructure faults in our city and region. Damage from Ida in our portfolio was definitely more pronounced and across a wider swath of properties that had not previously been affected by storm events in the past decade that I've seen. I think this signals that our responses are at this point still reactive, and while we're all working towards solving for what has happened, I think this entire platform is here today need to continue to adapt and to discuss that with as wide a variety of responses and solutions that this group might have. Next slide. So moving forward from 2012, we sort of again heard this as the call around the globe and in our small cities of Brooklyn and Queens. In 2018, members from our leadership team traveled to Rome as part of a U.S. delegation to meet with Pope Francis. And the group presented Pope Francis with a plan for the future sustainability projects in a couple of different cities, including New York, Chicago, and Los Angeles. And this was in direct response to the Pope's 2015 encyclical entitled Laudato Si, which is on care for our common home. And we use this as an innovative approach to outline a plan for renewable energy and other resources that will allow us to, in the future, and to continue to reinvest in sustainability and environmentally friendly initiatives across our portfolio. I think it's important to note that the encyclical Laudato Si starts that combating climate change and protecting the environment are both our responsibilities for the earth and for humanity as a whole. Next slide. So our next step in 2019, we launched the Laudato Si Corporation, which is a not-for-profit special purpose entity dedicated to advancing environmental sustainability and climate resiliency by generating renewable sources of energy and revenue. Our approach is unique in that it's addressing the low to moderate income, or LMI, affordable housing industry, and that we're providing ourselves the solar and the climate resilient infrastructure that we own, fund, and manage through the entity rather than a third party. And we can discuss, some other approaches that we explored in that, but that was a very sort of conscious decision that our organization made, to take this on ourselves and to try to steer it for at least the initial phase. Next slide. So I think it's important to note through Laudato Si, our income from solar projects supports the capitalization of a clean energy fund, allowing for further, deeper environmental, social, and governance, ESG, we've recapped today, benefits across our portfolio. In phase one, we developed a successful 3-building community solar project, which has approximately 150 kilowatts of renewable energy produced annually. And as of this past spring, we've sort of passed the milestone. We have all pending approvals and the systems are operational. So at this point, we are now able to say that we're providing community solar to our residents in some capacity. These projects were all done with roof leases provided at no cost to the organization, as well as with a 10% Con Ed electricity utility credit savings that we provide to our residents on a limited capacity. Next slide. So thinking about the future, in the past year, as we were finishing up phase one, we very quickly moved on to phase two, given that there's been, I think, even a more strong demand for the work that we're doing from a solar as well as from a resiliency perspective. So we began sort of a follow-up comprehensive review of our portfolio, as well as changes in the solar market. After modeling multiple financing scenarios and with the passage of the Federal Inflation Reduction Act, so the IRA, back in August, we now see a clear path forward. We're now looking at a portfolio, a new portfolio in phase 2 that would have over 11 sites approaching 675 kilowatts. So really sort of ramping up from our initial pilot approach. And then this approach would also continue to use the community solar approach, which was in question given that where we started in the conversation back in December of 2021, the market there had turned completely, and the numbers and sort of the return on investment was not looking as feasible. So we were really excited in August, as everyone probably else here on the call today was following the IRA legislation and how that came out and what that impact has on both the solar and the resiliency, as well as the affordable housing industry. So right now we are sort of in a deep dive trying to understand how the new tax credits can be directly refunded to us as a not-for-profit owner. It's really exciting that there is a direct pay option, which we can get into more details if that's helpful for the conversation today. But it's really changed, sort of the path forward for these types of projects that otherwise, don't necessarily pencil out for a not-for-profit entity to take on and to fully manage and to fund. Just to dive into that a little bit, at this point, we see that the project might be eligible for a tax credit up to 50% of project costs, and that's coming in after a base 30% incentive through the solar tax credit, as well as 20% bonus on top of that is coming from projects that are serving residents in a low-income household, as well as projects that are based in certain demand zones with peak energy needs, as well as low to moderate income households. And then I think here, it's important to note before we get into sort of the resiliency piece is that this portfolio, represents a cross-section of the most underserved and diverse racial groups in Brooklyn and Queens. And the 11 buildings that we are including are located in historically underserved communities. And it's our goal to help our residents and our households to benefit not only from the modest utility savings, but from an increased sustainability, environmental justice awareness. We got the next slide up. So we're going to pivot a little bit at this point and talk about our work combining both solar with resiliency projects. So we're now collaborating with MAP Architects and Bright Power here in New York. And we recently started work to develop a new building in the central Brooklyn community of Brownsville, which you can see here on the screen. This is a sort of very highly diagrammatic image where we're trying to show the interplay between a variety of different energy and resiliency approaches. And this was put together for an application that we submitted to the New York State Energy Research Development Authority back in July. And the goal here is to develop a replicable, sustainable approach for resilient senior housing. And so I'm going to go into a little bit more detail in the following slides, but the big picture of this building is that it's an all-electric project following passive house design standards. And we're really trying to explore and push the envelope when it comes to resilience, active, and passive survivability. Next slide. So again, if you are able to follow the many different leading arrows here, just highlighting the different pieces of the puzzle that we're trying to put together. So the big piece on the ground floor here is that we are looking to do a senior center that can be used as an area of refuge, not only for our residents, but potentially for the surrounding community during future climate change events. And so this would be potentially powered with a combination system of on-site renewable energy as well as battery storage, which would be the first for us. We can talk about more about the concerns and the challenges, but that is certainly one piece here in New York is combining battery with these types of multifamily buildings where there's not a lot of space to offset some of the fire department codes and concerns. So that is something that we are like in the middle of study right now, and really hoping to come up for some firmer solutions and answers back from the city agencies. And I think some other key pieces here that touch on just creative thoughts from a variety of different consultants on our team. We're looking at a potential demand response energy modeling system, which would again be used to where we share stored renewable power during peak electricity periods in the Brooklyn Queens demand management zone. So this again is an area of the city that's been identified as having very sort of high utility needs during certain periods of the day, the month, and other sort of seasonal events. And knowing that information in advance, we could potentially sell or give that energy back to the grid to help offset other types of peak burner plants and other responses that the grid takes on in a typical fashion. And then I think just the other pieces here are a little more tried and true, but just thinking about on-site stormwater detention tanks, permeable paving, and street bioswales, again, just trying to keep as much water on the site as possible during storm events to keep the surrounding community from flooding. So I think the big picture here is that this is a senior residence and within an older adult center. It can demonstrate not only that high performance and enhanced living are not exclusive for one another, but in fact it's critically important for vulnerable populations to really be thinking about these types of solutions.
And David, just wanted to know that we're at 10:55.
All right, I'm gonna wrap it up. Thanks for the warning. So just, in sum, I think, again, we started with a variety of different approaches when it came to our sustainability platform. And it's gone back and forth between both a mission approach as well as the return on investment perspective. And in the end, for us, it really landed on the mission behind our work and the populations that we're serving. That doesn't necessarily neatly tie up with financing opportunities and other sorts of financing constraints, but it's something that we keep in the front of our minds as we work through these projects. And then obviously we see some other opportunities here for operational savings, staffing changes, as well as what I hope will come out in the following conversations are anything when it comes to insurance, which we have not really been able to tap into yet. And I'll go to the last slide and wrap it up. We've covered a variety of this information already, but just in terms of the next step for us is to really dive into the IRA and how that's going to impact our work in the next few years, and to work as an advocate through the regulatory barriers that exist across the marketplace, and just continue our commitment to this initiative. And I will end there and hand it back over to Gabriella.
Thank you very much, David, for that presentation. And up next, we're going to hear from Jane Carbone. Take it away, Jane.
Thank you so much, Gabriella, and thank everyone for the invitation here. Very excited to participate and be part of efforts and hear other efforts on climate resiliency, because we're seeing obviously the traumatic impact of it, and we can't do enough quick enough. And I know we're all making this a huge commitment. And I'll tell you a little bit of the story of what we're doing at HRI. Homeowners Rehab is a nonprofit housing developer in Cambridge. We've been around for over 40 years, and I'm going to walk you through some of the projects that we've been developing in our sort of mission over the last 20 years on sustainability and energy efficiency and climate resiliency, and give you a brief talk about what the city is doing as well. Next slide. Next slide. So again, this is just our mission, the objective. One of our objective is to develop a 5-year framework to incorporate sustainability and planning into our ongoing green sustainability initiative for new construction, preservation of our existing affordable housing, and building operations and maintenance. Cambridge, we have HRI owns approximately 1,600 units in Cambridge, scattered throughout the city. We also have properties in Worcester, recently acquired another small nonprofit, CASCAP, that houses mentally disabled and elderly residents. And so that portfolio is in the greater Boston area as well as Cambridge. And so we're taking a deep dive into that portfolio to see what we can do to incorporate sustainability resiliency measures there. So the 5-year framework is for all of those properties. Next slide. So some of the resiliency goals that we look at are, hardening, which is strategies that reduce the facility's vulnerability, adaptation, strategies to improve the facility's ability, and whether it's a masonry building or a 300-unit development. We have sort of 3 units to 300 units. We have sort of the gamut of properties and different typologies in the community. Redundancy is strategies to improve critical needs to the facility in the event of loss of power, and behavioral changes, working with the residents to, educate them about sustainability and resiliency and what they can do to improve our measures. Next slide. So in the past, we've looked at energy efficiency upgrades, incorporating insulation, heating systems through the utility programs, water efficiency, low flow toilet shower heads, aerators, and renewable energy. And we're always looking for opportunities to improve those measures through construction techniques and work with different financing programs and certification programs to help us look for funding for those programs. A lot of these measures have additional costs to them, and trying to find the resources, especially in affordable housing, can be a challenge. Next slide. So we started a solar program in 2008. HRI created its own green loan program. We have, as a nonprofit, we do collect fees on our projects, but those really go back into our properties in terms of resident services or what improvements we could make, also updating our replacement reserves. And so we realized that there was not a lot of funding for renewable energy at the time, and so we had available funds. So we created our own loan pool, and we're able to install solar PV and solar domestic on several of our properties starting in 2008. So we had about 10 buildings, and more recently we're partnering with Resident Energy to add 23 more arrays in our properties. And this is through, we started through the green loan, but the Inflation Reduction Act now, as David had talked about, is going to allow us to take advantage of additional tax credits, so that we're going to flip our the financing, which was a power purchase agreement, now to HRI directly owning the systems and going through the Inflation Reduction Act. So right now we have 261 kilowatts of energy, and the planned solar PV will increase it so that we'll have a total of 375 kilowatt throughout our portfolio. Next slide. We have properties in Cambridge. When we're looking at opportunities, if we have to do a gut rehab, we have residents are moved out of the building. In this case, we actually had a fire. So we wanted to see if we could do as deep an energy retrofit as possible. We have 6 buildings now that are net zero. And this one is will be close to net zero. It'll be an all electric building. It has, we got some additional funding from the triple decker challenge in Boston that they're trying to incorporate ways. The Mass Clean Energy Center was looking for ways to get triple deckers to reduce their energy efficiency and try to achieve net zero. So we applied and met the goals. And this will be also Cambridge Historic Commission gave us funds, and this will be added insulation on the interior because the exterior was in good shape. And we're also doing moisture resistant materials, construction waste management. We're doing air sealing. We're part of the Enterprise Green Communities. The goal here is to get the certification, which we've done in all of our projects, new construction and or rehab. Next slide. So that's on the smaller scale. On a larger scale, 808 Memorial Drive is a 300 unit development right on the river of Memorial Drive in Cambridge on the Charles River. And we purchased this in the 90s and did a modest rehab then. And when we first bought the building, on a wind-driven nor'easter, of the 300 apartments, about 270 apartments had water penetration, air leaks, water leaks that led to mold, that led to issues that we had to resolve on the interior. And so we did a repair where we recoated the building and recaulked all the joints, and it was a concrete structure, 19 stories. And that lasted maybe 15 years. And with the continued wind and rain and storms, we realized that we had to do a more robust exterior cladding program. So we are in the second year of the renovation here. We're about 96% complete when we completely reclad the building. And this is for several reasons: to make it airtight, more energy efficient, and also to minimize the risk of some of the measures that you would see from the storm events that are occurring. And on the right, there's the wall cavity shows that the original rib face block, and then there's a new structure that had to be attached to adhere so that the cladding could get adhered to. And then the cladding is 6 inches of insulation covered with a metal panel. Next slide. And this was during the construction was during COVID. We had that project during COVID, which was a real challenge because it was also occupied rehab. We had to move families out for three weeks while we renovated and upgraded their units to energy efficiency appliances and water efficient toilets and fixtures, as well as insulation. And so on our new construction projects now, our goal is really to achieve passive house, which has some great resiliency features. And David talked about them too in his slide, and how new construction passive house really is a great opportunity to incorporate resiliency measures in the design from the very beginning. Here, this was finished in 2020. It was the first largest 98 units, 100% affordable, and it was the largest affordable housing development in 40 years in Cambridge at the time. And fortunately, there are many more projects coming that have started behind the development that are also passive house. And the state now has incorporated in their tax credit QAP points for passive house. So they're seeing the need for these resiliency measures in affordable housing. And that's one resource that all affordable housing developers in Massachusetts and across the nation use that program. So there was a huge lobbying effort to get the QAP to incorporate the passive house requirements. And we also got funded from the Clean Energy Center, and again, Enterprise Green Communities and Fitwell for health and wellness design. And we incorporated designs using Fitwell measures. Next slide. So some of the resiliency measures, it's a podium structure. There's no living space at the ground level. We have a shelter in place at the top floor of the community area. It's has a generator and families can shelter in place there. And also we have for the landscaping, the plan, we have a 8,000 gallon tank that collects waste on the site. And then after, if the city has a storm event, we will capture our waste on the site. And then after the storm event, it goes back out to the city system, and it's separated. Storm and sewer is separated here in this neighborhood. We also have a Cultec system, which is 20,000 gallons that is also to collect stormwater management on our site before it goes into the system. So if they're getting taxed because of a storm event, then our site can collect the stormwater from rain on the site. And we also have pervious paving and landscaping materials that and landscaping plants that are drought tolerant and pervious. Next slide. So I think, and we've designed it to the residential units are designed above, they're above the 2030 and 2070 flood elevations. So you can see some of the air sealing. So we used, it's 2x6 walls, not 2x8, 2x6 walls, and they're blown in cellulose insulation, not fiberglass, sorry, and then a Siga air barrier. That was actually a material that came from Sweden, and they just actually built a manufacturing facility in New Hampshire, so that Siga is just an amazing product that a lot of folks doing passive house use for an air barrier on the buildings. And then you can see the mineral wool, which is an additional insulation. So the thermal bridging, you know, we're reducing thermal bridging on the exterior, and then the cladding is on top of that. We have HVAC, 2 ERVs and a VRF, the 100 solar renewable system. And the only gas, it's all electric, except at the time we were in design, the domestic hot water, we couldn't find a feasible domestic hot water system that was electric. So we ended up with, and now there are other products, but it is a gas for domestic hot water. And then the last picture is a compartmentalization where every unit has its own fresh air brought into the property, and it continuously exhausts fresh air. Next slide. And air tightness is a slide of just how careful you have to be and making it airtight to maintain the features of passive house and resiliency. Next slide. And you see that, you know, a lot of training goes on the site where, you know, you have the design in place, and then you try to practice the method. And then on the left, that was the first attempt. On the right is the final attempt, because you really want to stop any water or air from coming in the building. Next slide. And so this is a chart that a slide from the city of Cambridge, and I think other people have also said that the heat is really an impact in the higher degree days, over 90 degrees on the left. From 1971 to 2000, there were 9 or 10 days, and now there's over 30 days, and that's increasing. And this, where Finch is located in Cambridge in the high quadrangle area, there's a lot of, that's an area that has fewer trees and less and more asphalt. And so we're trying to think of, and the city citywide is incorporating measures on climate resiliency and climate goals in zoning, and so targeting some of these more vulnerable areas. And so some of the measures are white roofs and impervious paving and adding additional trees. Next slide.
I just want to give you a 2-minute warning too.
Okay, thank you. So this is just a checklist of where we were at and where we're going. I mean, we started with Energy Star and energy audits, green capital needs assessments, which is a product of every unit doing every apartment building doing a 20-year study of what capital work you need over time, and incorporating healthy materials in the 2000s, you know, working with LEED and the utility programs that we could resource funding from. And then in the 2014 to the present, we're focusing on achieving net zero, getting to passive house, aligning our carbon reduction goals with the city of Cambridge's, and we are also part of the HUD has a better climate challenge goal where we're trying to reduce our reliance on gas by 50% by 2030. So in our whole portfolio, so we're moving in that direction as well. And we also now are producing zero overtime reports in our portfolio. So look at each building and seeing how can we achieve a zero overtime in this particular building. If it's a renovation, if it's the end of a tax credit period, you know, where you capitalize a property, what can you do? And giving information to the residents about what they can do. Next slide. Partnerships, as I said earlier, we're working with the Better Climate Challenge. WeGoWise is a software that we use that basically tracks all our data. At Putnam, at Finch, we're tracking water, gas, electric use, we're monitoring air quality in the apartments, and then we're giving that information and using it as a resource to see how we can improve it, what needs to change, what things come up that we have to identify. If we see a water leak, we'll see that coming up through the data from the properties. And the Lean Multifamily Program, we're also working with the Rocky Mountain Institute. They're trying to come up with 1,000 family challenge to see how many buildings can get to net zero in the next year. And we're giving them information on our portfolio to see if we can be part of that 1,000 unit challenge. A lot of it is single family homes, but again, in our neighborhood and area, we have more multifamily, and that's the portfolio, and those are the families that we're trying to reach. Next slide. That's the end of my presentation. I do want to say that we're also, the Clean Energy Center has been a great resource for us, and originally for Passive House, you know, and I think for climate resilience, Passive House is really one of the most important tools, and they originally gave us grants, but now we're looking at additional funding. We're hoping that the federal and state agencies come through, and I know ARPA money we're trying to channel ARPA money at the state and local level to see if we can use those resources for our residents. They certainly qualify, and we can use some of those funds for climate resiliency measures within our portfolio. And again, the city is working on zoning strategies to help mitigate climate change, and hopefully those policies will be in place in the next 12 months. And just I guess I'll take questions.
So thank you so much, Jane. We're going to take the questions during the panel, so please continue to share those through the chat. And now I'm going to hand it off to Lori. Lori, take it away.
Good morning, everyone. It's great to be here with you all virtually. Good to see David, Jane, and the entire team. And thank you for stepping forward and learning from this really important set of presentations today. So I'm really excited to share with you a little bit about what enterprise and what we've been doing in this climate risk space. You'll have to forgive me. I may have some noise in the background. I've got my son is home today. We are in the days of COVID. We've heard some great stuff about what can be done to improve housing, to mitigate housing from climate risk and adapt housing to changing housing conditions. My name is Lori Schumann. I work in Enterprise Community Investment, which is a division of Enterprise Community Partners. I work in our capital team to direct climate and sustainability across our business lines. We have been around and are celebrating our 40th anniversary this year. Our goals are to increase housing supply for the nation, because we can't discuss issues such as manage retreat or safeguarding communities from risk if there's no housing to provide alternate shelter to folks. So we need to increase our affordable housing supply around the nation. Also, we're looking at advancing racial equity. Many of the legacy issues that still continue to plague our communities are very much at root issues around racial equity. So we're advancing racial equity through a variety of lines and building resiliency and upward mobility. And so the work that I lead in the capital division is very related to not only our strategic goal to build resiliency, but also our emerging ESG platform, which we'll talk about. Enterprise has built, preserved, and own and operate housing across the nation. We've constructed and financed close to 900,000 units of housing. We own and operate 15,000 units in the Mid-Atlantic. So we are a one-stop shop for housing. We're the only entity in the nation that is engaged in every aspect of the housing life cycle, from creation through preservation, through operations, asset management, and development. So it's an exciting time to be here. And I've been at Enterprise for many years, about 8.5 years. And one of the things I love about Enterprise is I get to work on policy, I get to work on solutions like programs, and I get to work on understanding how we finance all of this work, because at the end of the day, we need to pay for this work. It does not pay for itself, unfortunately. I'm going to assert to all of us that climate change is not the problem. We are. We build our housing in floodplains. We don't invest enough in maintaining and operating our housing so that it's more exposed to climate risk. And we don't build enough of the housing. So we are facing the risk of climate change, and it is not going away. It is increasing. What we're seeing in Florida today, the hurricane has now moved to the Atlantic. It's coming back to the coast this afternoon. It's going to move up the East Coast. There's going to be surge flooding, and it may even land as we saw Fiona in Canada. These storms are getting stronger, and they're getting stronger, they're getting slower, and they're getting more destructive. And that's just flooding. The nation is dealing with 17 perils around climate risk. And those are everything from fire to earthquake to, which is a natural hazard risk, to hail, to flooding, wind. So this has become a material issue for our industry. And I'll speak with my hat on the capital side. Investors more and more want to know, how are we managing our risk? Not only do they want to know, but the deals are getting more expensive because insurance is rising. In some situations, we can't even get insurance, or insurance is so prohibitively expensive, we have no way of paying for it, given the cap on the affordable housing units. And I want to mention that our business lines consist of our Community Development Finance Institution, our CDFI, our housing syndication, housing credit syndication line, which is our largest business line, LIHTC. We also have a real estate equity line, which aims to help investors invest in really good projects like Equitable Path Forward, like buildings that exhibit some really wonderful and innovative social qualities. And we also have a new market tax credit line. So we've got a lot of business lines and a lot of different investors. But the one thread among all investors these days is, what are you doing to manage your climate risk? So what we've created is a climate risk reduction platform, which has kind of cobbled together a lot of the tools that have been developed over the years at Enterprise. And we are bringing this platform together to help our frontline staff, our developer analysts, our syndicators, our originators, our underwriters understand, how do we manage climate risk? And we start with identifying your hazard exposure. And I'm going to show you a tool about that in a second. Then moving into assessing our risks at the building level. We want to make sure that we can get into the buildings and understand what's going on in the buildings, so we have a better sense of how to manage risk. Because remember, we cannot manage what we don't understand. Then we have a whole set of tools to help us determine what those strategies are, which I'll introduce you to in a second. And then really implementing resiliency strategies will require significant support, technical assistance, and funding and financing. So at the end of my presentation, I'm going to talk a little bit about some of the really interesting and exciting federal dollars coming forward, which I think you'll all appreciate, right? More money, because we need as much as we can get. So our first tool, Climate Safe Housing, is a tool that we created after Superstorm Sandy, but we've just revised it. And what this is a multifamily specific site that provides you with all of the various strategies you need to understand to mitigate your risk. We look at protection, which are your straight mitigation engineered solutions, which David talked about, adaptation. And a lot of these solutions are about your site and adapting to future risk, backup, as well as community. And the community strategies are about the sort of software of the building, the business continuity, the operations, how people exist together under one roof and how they work together. And this is available to everyone. We'll make sure you have this site after the call. We have a follow-through tool, which is really a single family focused mitigation support. This is a very important tool called Keep Safe. It's a guide for resilient housing design. It was founded and formed in Puerto Rico after Hurricane Maria. It is a labor of love. This tool is available in English and Spanish. It essentially, we asked the question after Maria, how do we ensure that federal funds coming into Puerto Rico after the storm would be able to strengthen housing in the island? And 5 years later, it's amazing to me, we're back at the same place right now. Fiona devastated Puerto Rico's energy grid, and a lot of housing was damaged. So a lot of the lessons we are providing in this tool is very relevant for today. In fact, this tool, this book, which is now a website, has been used to inform a lot of the resilient housing that's being built in Puerto Rico right now. And it's really a step-by-step as to how you build a resilient home, starting with identification of your hazards, moving through your site, going into the building structure itself, right? Maintaining continuous load path, passive habitability, moving into energy, then water, then household preparedness, and then community engagement. And then we have a section on how to put it together. So this tool is very helpful for folks that are working in rural communities, islands, territories, and single family. So we have worked in this space for many years. We have programs all over the country that are dealing with a variety of climate risk issues. A program I wanted to share with you all today, which I'm excited about, is called Keep Safe Florida. It is a timely moment as the hurricane moves out of the straits of Florida. There are a lot of housing units that are damaged in Florida right now. What we have developed is a program that we launched 2 years ago. And this is a program that essentially helps to bring multifamily housing owners the support they need to identify their risk and strategize on their actions. And here's how this program goes. I want to share this with you because this is something that is very important as you think about how do you deal with your risks and manage your risk. So we start with the goal of helping to support our building residents and operations. And then we ask you to identify your risk via an online tool called Portfolio Protect, which we will send you that link. And then we ask you to assess your vulnerable properties with a tool called Building Protect. It's a self-assessment tool that you can walk through your building in an hour, answer the questions, and then what you get is a building report. This is a report that outlines everything you should think about as you move through retrofitting your facility. And it can even be for new construction as well. Then we provide you access to a community-specific funding guide, how to finance this work. And then we provide you with training on getting a business continuity plan together. You can use that to work with your residents and make sure they're safe. And then in some jurisdictions, we actually have loan programs that help us fund this work. So Miami has a loan program that's available, and this actually helps fund the retrofits. And then you're able to manage your risks and manage your climate-related exposures. This whole life cycle is informed by a lot of our work. One of the programs that inform this is a program that David knows well called Flood Help. David Downs and I were, David was at Enterprise for a while and led the Flood Help program in New York for some time. And so there's a lot of really interesting stuff that we could share about that. But what we've done is taken that model and We were asked to bring it to Florida by Florida jurisdictions, and now we're working with HUD to bring it to the rest of the nation. So there's going to be a lot of interesting work to try to figure out, okay, what are the other hazards and perils we need to think about as we go forward? Okay, so great solutions. We've got a lot of ideas, lots of good stuff. You have to answer your investors when they ask you, what are you doing to manage risk? And so what I've just presented to you is a way for you to think about, how do we manage multifamily housing specific risk from a climate perspective? But what's driving climate risk recognition, and what is driving our industry to ask about climate risk and manage it more closely than ever before? I've been in this field more than a decade and a half. And I mean, this is a hot topic today. And it's not just because we think it is. It's because utility costs are rising exponentially, 20, 30, 40% in some jurisdictions. And in some jurisdictions, like Miami, there are communities, low-income communities, mostly communities of color, that do not have enough treescape. There's not enough cooling centers. People can't afford air conditioning. So rising utility costs are hitting our pocketbooks. The other big material issue that's hitting our pocketbooks is, of course, insurance volatility. We have an event coming up on Tuesday, which everyone's welcome to attend, with the National Association of Insurance Commissioners, to talk about investment in affordable housing and really getting insurers to invest in affordable housing. And one of the topics we're going to discuss is how to reduce discount rates for insurance with incentivization of mitigation and adaptation, right? If you are putting in a fire stop in your home, you get a reduced insurance rate. If you have a bag on your car or you have a good driver record, you get a discount. So we're asking, what can we do for the multifamily housing space, given the volatility of insurance? And this is a whole other discussion, but there are a lot of good examples on the single family housing side. The third piece is the Community Reinvestment Act is modernizing. There is going to be additional credit for investment in communities that have exposure to climate risk, and we'll be getting the attention of banks that are investing in these communities. This is a really important thing to watch, because the CRA is one of the most foundational tools for affordable housing investment in the nation, as well as community investment for that matter. ESG. I'd love to do a raise of hands in this room. Who knows about ESG or is engaging with an ESG framework? It is a set of very progressive values that are being are seen as ways of not only mitigating the risks that we face from an environmental, social, and governance perspective, but trying to understand how we manage these risks with a progressive and innovative approach. The affordable housing world doesn't have a lot of ESG examples, because affordable housing, not market rate, does have more examples like Vornado and Cushman, but most of the affordable housing world is seen as a social good. So why do we need an environmental social governance platform? We do, because our investors are asking us, and we can really take advantage of this moment to say ESG values are values that are in our DNA, but that we want to get a little bit more clear about how we show up in this space, because there's a lot of investment. And then, of course, asset management. Climate risk is putting a lot of pressure and risk. Just seeing what's happening in Florida alone, when you have affordable housing that has been underinvested in or is in a floodplain, you're going to have asset management triggers. These are all driving reasons why this work is showing up. So in my last couple of minutes, I want to share with you some really exciting stuff. So we've all been hearing about the Inflation Reduction Act. We also heard about the jobs bill. So there's a lot of funding that's coming forward for our community. While we didn't get a specific explicit large S or set aside for housing, save the $1 billion going to HUD for clean energy, there is a lot of corollary support for our housing field that we need to pay close attention to. And enterprise is at the center of a lot of these discussions. Wanted to highlight a couple of really interesting projects. One is $1 billion going to HUD for green energy retrofit. you should all be thinking there's an RFI that's come out on Monday from HUD on this program. It's important that you give voice to what you need in this program. They're taking lists now. And if anyone wants to visit my LinkedIn page, I've got a lot of information on this. But this is a really great program. It's going to go to multifamily and affordable. It's going to be specifically to deal with our issues. Number two, there's $26 billion coming out of the EPA for GHG emissions. There is discussion, and it's happening right now, that a national green bank will be created to help deploy this funding. But we as a CDFI think that this funding will be very helpful for our community work, for our housing work, and for academic development work. So pay attention to that. The ITC expansion, the solar tax credit, is really exciting. Lots of really good advantage coming forward in terms of the extension of the credit and some innovation around how the credit can be integrated into the stack of our existing funding and existing tax credits. And there's a lot of excitement around the ITC expansion. DOE has $27 billion of clean energy in their accelerator program, and we're really pushing them to think about affordable multifamily. We're also pushing the EPA to really think about affordable multifamily. And speaking to folks from the White House down on the importance of having this funding set aside for affordable multifamily housing. Enterprise is going to be doing a presentation in about a week and a half on this stuff. Please come, because you're going to learn a lot of good information and identify ways you can give voice to your needs. That's where I'm going to close. Here's my LinkedIn account if you want to get in touch. I want to thank the organizers today for inviting me here to join this esteemed panel, and I'm going to close out. Thank you very much.
Thank you so much, Lori. So now we're going to take questions for all three of you, for David, Jane, and Lori, as the next portion of our program before we close out for the day. See, we've got some more questions coming through in the chat. I wanted to first ask a question for David and Lori, since we are seeing all of these hurricanes. We're in the middle of hurricane season. You've both done work in places where there's been some big impacts from hurricanes in the past, and have seen that hard and long path to recovery after a hurricane. So I'm wondering, like, what lessons or insights you might have to share when it comes to affordable housing within that context.
Lori, you start. I'll fill in.
Okay, David, it's so good to see you. David and I have been in the trenches together. We can tell folks all about what that looks like to walk through a NYCHA garbage facility. You know, a lot of affordable housing owners are dealing with just so many challenges, from regulatory compliance to dealing with tenant related issues. And so much of our affordable housing partners do not put the time in before an event to create their business continuity plans or to retrofit their facilities. This is why we're pushing adaptation. We're pushing pre-event disaster preparation mitigation. One of the things that affordable housing owners need to understand is, following the event, there are federal funding streams that come forward. They need to be aware of public assistance being available to housing owners. Setting expectations with their residents and their community about what they're able and not able to do. Coming out of a recovery event, coming out of an Ike or a Fiona or an Ian, will mean that there needs to be leadership at the housing team level and at the jurisdiction level around the affordable housing stock. You know, recovering is a long journey. It's a long process. Most of what happens in multifamily housing is that their systems go out, right? The innards fail, and that's a real trigger for habitability. So we have a whole program on how to deal with the issues beforehand. And afterwards, it's really a triage mode, but afterwards is a time when there needs to be leadership. There can be no questions about who's managing the response. And it needs to be very clear. But this is a great discussion, a great question, but there's no one size fits all. I will mention we have a fund called the Disaster Accelerator Fund, which is we can make investment or provide bridge funding to housing operators after an event while they wait for their federal dollars to flow. So that's one way we've created a solution to help these owners recover quickly.
Thank you, Lori. David, do you have anything you'd like to add to that?
No, I was just going to be very transparent in that I've actually never been in an organization where we've had a huge post-storm cleanup to deal with. But I mean, working on the enterprise side, you know, the flood help platform, I think it's you know, definitely a good place for folks to start to be in a proactive sense. But then enterprise from that point, as you highlighted in your link, Gabriella, has a whole slew of you know, places for organizations, you know, specifically not-for-profit affordable housing providers to go to if they're in that position. So I think that library is exhaustive.
Thank you so much. My next question is for Jane. We have a question for you about contractors. Did you have any trouble finding construction contractors who are able to build passive house standards and perform deep energy retrofits in existing buildings in a cost-effective way?
So I think contractors are, I mean, we started 3 years ago on the design, and there weren't that many contractors that were passive house knowledgeable. And I think the Clean Energy Center is, you know, they're very, they had great goals to incorporate as much passive house as possible. So they created workshops, and they still do online training for contractors. And they have many opportunities, as well as the Passive House organization, passivehouse.org. So they can provide training. So now there used to be a handful, but now there are a lot more contractors that are learning the tools, getting the training, and getting their subcontractors to be trained. Some of the measures, I think it's still a work in progress. I think the architects have to really pay attention to the details and making the details feasible so that you can actually build it in place versus hiring an engineer to, you know, be on site while you're doing modifying the details. So I think if the architect simplifies details for passive house, then it's really just tight envelope and making efficiencies with the heat, with the mechanical systems. So it's definitely a trend that's moving in the right direction on gaining more knowledge and experience and opportunities for folks to learn.
Thank you so much. You mentioned tight envelope, and that brings me to a question that was directed at David, but I think could also be for you, Jane. So maybe we start with David and then you add on. So you build multifamily designs that have passive house envelopes and heat pumps. They usually have means of energy recovery and really great ventilation, filtration, humidity control, all of these things that improve indoor air quality. So in your return of investment calculations for investing in these kinds of buildings, do you consider how these might also have co-benefits when it comes to resident health? And if you do, how do you make that calculation?
So I'll dive in. I want Jane to follow up because I know that HRI, again, we worked together for a few years. And so we know quite well that, you know, HRI and Jane, you know, under her leadership have been, you know, pioneers in this field. But just very quickly on the slide that I had skimmed through, you know, there's a lot of information there about health co-benefits as part of our approach when it comes to our passive house design. And you know, I'd say to the question, we have not put in the financial impact yet into our calculus when we go to subsidy providers. We're trying to figure that out as we speak. So again, this is where the city is asking us to follow, you know, these, you know, not necessarily passive house standards, but enterprise green communities. And we want to do a lot of the things that Lori talked about, the things that Jane talked about on her side. But then it comes to the you know, the chopping block when we're looking for the subsidy, and these are sometimes some of the first things that get cut. So the short answer, no, we have not put it in from a financial perspective, but we are putting them in from a, I'd say a minimum design standard approach is how I look at it right now. So we're trying to achieve it as much as possible and figure out the financing as we go. Jane, do you want to add to that?
Yeah, I'd say pretty much the same thing. We haven't figured it out on the financing side. But for programming, you know, I think our goal is always to improve indoor air quality. And, you know, we did a quick study on a development that was completed back in 2008 where we used LEED, and then all the materials were low VOC and no VOC, and there were some residents that moved into that development. It was home ownership, that their children had asthma before they moved in, and then over time we were just checking in on them, and they were saying they virtually practically eliminated emergency room visits. So Passive House takes the next step, and one of the reasons why, and through the city of Cambridge, we modified the zoning for when we were going in for building permits for affordable housing. Enterprise Green Communities has a more robust program, because the LEED program really focuses on the building, but the Enterprise Green Community focuses on the residents and the programs that you create within the developments to make them healthy. And so the city now incorporates for any affordable housing development that you seek Enterprise Green Community goals, and those strategies are now in place as a requirement. So indoor air quality is a focus. We're tracking it at Finch, so we're getting to see what the data is going to be like, and hopefully can share it shortly.
Thank you so much. Jane, you were just talking about also like programming within the buildings, and that connects to another question that I had for both of you, which is, along with, you know, the physical resilience and sustainability features that are being added to your project, what are some, if any, like education and programming components that go along with that, both for residents to better understand the buildings that they're living in, and also to sort of reinforce resilience and preparedness or social resilience efforts?
Well, Enterprise, that's another thing. Again, Enterprise Green Communities has, as part of the requirements to get their certification, they require a handbook that you provide to residents. And so we've designed, every project designs a handbook, and it tells people, you know, these are the energy efficiency appliances. This is how you operate your thermostat. This is the equipment that's here. We also have a monitor in the lobby that goes through, you know, the solar PV and what the savings are and what it looks like. We also have a robust resident services program that provides programming. So we'll have workshops within the we'll have workshops in the community space that talk about you know, how they can save energy, how they can. We also have the nature connection, and they come in and talk about the connection to nature and the environment. And we're working on some climate resiliency workshops with young kids, so that they can do some artwork and see what, you know, a flood versus a weather event and what that means. So trying to work with the schools to get some, also doing some programming for gardening, and again, making that connection to nature to see how important it is, that it's not just, you know, living in a building, that there are other community opportunities for you to participate in, and see the importance of that, you know, watershed, or that the wildlife in the adjacent neighboring areas. So those are some of the goals. And then, you know, that's why Enterprise Green Communities does really give us all those boxes to check, to incorporate that from the construction to the development to then ongoing operations and management of the project property. I don't know if David has more to say about that on his.
No, Jane, I think you covered it. The only thing I know you guys do, and something that we're trying to start at one of our buildings, is you know, that furthering that connection to fresh food and the environment, bringing in farmers market and other types of food access. A lot of our buildings have ground floor community centers that we operate as older adult centers, sometimes Head Start facilities. So just making that connection sometimes physically with the building infrastructure. Jane talked about garden boxes. That's a really, easy, tactful way to do it. Then also bringing in other types of healthy cooking and services that reinforce that concept. So taking us a little bit away from, the hard resilient infrastructure that I think, is the backbone of this conversation, but it's definitely something that we're trying to pick up on the end when we think about healthy living holistically.
Thank you so much. So we started off our day by sort of talking about the landscape, big picture, and we talked a lot about policy. So for the last question, I kind of want to bring it back to that and ask, what are some policies that could help you all better provide resilient, affordable housing? And, in that mix, how important is municipal versus state versus federal leadership in supporting that success?
I'll dive in really quickly. I think this conversation has touched on many needs. I think the insurance piece is certainly one that we are struggling with right now, as rates have just outstripped all of our projections as we go into from a financial closing to a building becoming operational. And this isn't just buildings with flooding or other climate needs. This is across the industry. So I think both Lee and Dan put some of that framework out there, but we need advocacy for it. And I think we've been talking about this for quite a while, and I still don't really see what the real trajectory is of that. So that's the first piece. Jane, do you want to throw in some of your needs?
I think it's funding. I think Mass Clean Energy Center was a real catalyst. Now I think the utility programs are gearing up to fund air source heat pumps, and they're still trying to find the cost effectiveness of some of these measures, which is kind of frustrating because it takes a while for them to get out of that mentality when we know that air source heat pumps and some of these other mechanical systems and renewable energy is really the direction we should be going in. So we find that the resources come not too late, but they slow to come. And so I think at the state level, we're hoping to get some funding, and then at the local level, we're always trying to find resources. The city of Cambridge has a robust affordable housing trust fund, but they don't want to capture or use those funds for any of the climate resiliency goals. So we're trying to figure out ways to get other resources to help pay for that, because there are premium costs, and the insurance, like the operational cost, is real. We're seeing it used to be 3 to 5% in insurance, and now it's 10 to 15% cost increase. And gas and electric are also coming up and getting expensive. So we don't want to pass those costs off, and we can't, to our residents. And so trying to figure out ways to mitigate that. We haven't seen our insurance go down because we have a passive house. We tried to lobby hard. We have smoke-free. Our whole portfolio is smoke-free. So we're trying to say, why should we pay a higher insurance premium if we're smoke-free and we're a passive house? But we have not seen those industries make any changes because of that. So I think, more to come, and we need to continue lobbying for it.
Thank you so much, and thank you to both of you for your presentation. Before I hand it off to Kelly again, I see that, Dan, you're still with us, so I wanted to see if you had any final closing thoughts you wanted to share kind of after these other presentations.
No, I really enjoyed hearing the presentations today, and my humility was warranted. There is so much we have to learn here, but it's really great to hear the different speakers talking about at a kind of more on the ground level what y'all are doing. So I was listening with great interest, and and reached out to at least one of the speakers saying, hey, how can FHFA ensure that our regulated entities help you all and be a part of the solution? So thanks for having this. I really think more and more of these types of forums are necessary to increase awareness and really to figure out what can we do? What more can we do to be a part of the solution? So thank you for inviting me, and I really enjoyed hearing all the speakers. Every last one of them has just been really, really helpful. So thank you.
Thank you so much, Dan. And now I'm going to hand it off to Kelly to close us out.
Okay, thanks, Gabriella. I want to start by thanking all of our attendees for participating in this great conversation today. Every single forum, I'm always stunned by the rich chats that happen sort of in parallel with the talks and the questions that come up from the attendees. So thank you all for taking the time to come and listen and participate in the conversation today. Of course, I want to also thank all of our speakers. We really appreciate your time, your perspective, your insights. It's wonderful to have to bring such knowledgeable folks together to have these types of conversations. And big thanks to Deanna, Jason, and Gabriella for all their hard work in organizing today's forum. Our next forum will be on the topic of nature-based solutions to climate resilience, and it will be on December 9th. So you got a couple months. We're going to dive into how we use nature-based solutions to both cost-effectively reduce flood risks and enhance ecosystem services, and look at the feasibility and effectiveness of scaling some of these pilot projects that have been successful up to full-scale projects. So look out for the formal announcement in the coming weeks. We're really excited about this topic, and thanks again to everyone who participated in today's forum.